You know, they always tell us to watch the stock market for clues about the economy. But what if I told you the most accurate pulse of what's really going on isn't on Wall Street, but at your local McDonald's drive-thru? Today, we're diving into how the golden arches are sending out a huge warning signal, one that a lot of the official sources just seem to be missing.
And that question, it's really at the heart of what we're talking about. Because look, the most telling economic signs don't always come from these super complicated government reports. A lot of the time, they show up in our everyday lives, right? In the simple choices we all make. And right now, the menu boards at fast food joints are flashing a major red flag.
All right, so here's our game plan. We're going to start with the warning sign from McDonald's itself. Then we'll look at the data that shows our economy is basically splitting in two. We'll see how that trend is spreading to other big companies, compare the official story we're being told with what's happening on the ground, and finally, we're going to get to the real root of it all, debt.
Okay, first up, the McDonald's warning. For decades, McDonald's has been this surprisingly reliable mirror, reflecting the financial health of the American working and middle class. But the reflection it's showing us right now, well, it reveals a pretty deep and uncomfortable crack in the economy.
So let's be clear, this isn't just a story about hamburgers. This is the story of an economy where the official numbers, these sort of statistical illusions, are smashing right into a much more painful reality for a lot of people. And it just so happens that the fast food industry is ground zero for that collision. It's where we can see the impact in real time.
And that brings us right to our second section, an economy split in two. Now, to really get what's happening, we have to look past the headlines and decode what's inside McDonald's latest earnings report. Because buried in those numbers is some seriously compelling evidence of this stark economic split.
At a glance, the company's earnings looked pretty good, right? Sales were up, both around the world and here in the US. But that was a bit of a magic trick. The reality, which they confirmed on their own earnings call, is that this growth was almost entirely because they jacked up prices, not because more people were coming through the door. It wasn't a sign of strength, it was a way to keep revenue up while the market was actually shrinking.
In fact, McDonald's management used a very specific term for what they're seeing, a bifurcated customer base. Now, that's a fancy way of describing what economists call a K-shaped bifurcation. Just picture the letter K. It's when one group trends up into the right while another group trends sharply down. One part of society is doing great while the other is getting absolutely crushed.
And wow, the company's own data shows the two prongs of that K with stunning clarity. First, traffic from their core, low-income customers. We're talking folks earning under $45,000 a year. It cratered by nearly double digits. At the exact same time, traffic from high-income customers increased by nearly double digits. Now, this wasn't because wealthy people suddenly got a craving for Big Macs. It was a clear sign of them trading down from more expensive places like Panera or Chipotle.
This chart just makes that K-shape crystal clear. The higher end of the economy is feeling just enough of a pinch to practice a little reluctant frugality. You know, swapping a $20 burrito bowl for a $15 fast food meal. Meanwhile, the lower end of the economy has completely fallen off the map. McDonald's is basically swapping out its loyal, traditional customer base for a much more fickle, higher-income crowd.
And this right here is the most critical takeaway. The traditional McDonald's customer isn't just buying one less burger a week, they are vanishing. They're gone. The company admitted this isn't some tiny blip. It's a trend that has been going on nonstop for 2 straight years. We're talking about households so financially squeezed they can no longer afford what used to be the cheapest, easiest food option out there.
So, yeah, that begs the obvious question. What in the world is driving them away? Well, the answer points to a double whammy, a crisis of both affordability and quality. It's a total breakdown of the brand's entire promise. Let's start with affordability. People all over are reporting just extreme sticker shock. Get this. One customer posted a receipt showing a price of $8.29 for a single Egg McMuffin. No, not the meal with the hash brown and the coffee, just the sandwich. $8.
And it gets even crazier. Other reports show a standard meal ringing up at $15, sometimes even $20. I mean, at that price point, fast food isn't even value anymore. It's competing with actual sit-down restaurants. These prices are just a slap in the face to the brand's identity and a world away from the 59-cent hamburgers we all remember.
And what makes the sticker shock even worse is this feeling that the quality's going downhill. People are noticing. They know they're being asked to pay more for what feels like less.
You see reports all over the internet about cheaper oils changing the taste of the iconic fries, and suspicions about lower-grade meats. That combination is absolutely toxic for a brand. When the price is no longer a deal and the quality is questionable, the whole reason for going there just collapses.
The company's response to all this just shows how confused they are. On one hand, they're pushing $5 value meals, a clear attempt to win back their lost low-income customers. But on the other hand, they're testing things like crafted sodas to be more like Starbucks and appeal to those high-income folks who are trading down. These two strategies are at war with each other. A brand can't be a bargain bin and a boutique cafe at the same time. It's the classic sign of a company that has lost its way because it lost its core customer.
Okay, so now let's zoom out a little and see how this sickness is spreading. Because believe me, this isn't just a McDonald's problem. The warning signs we're getting from the Golden Arches are being echoed all across the consumer economy. This is a systemic issue. This K-shaped split is being confirmed by pretty much all of their competitors. The most dramatic example is coming from their rival, Wendy's. But we're also seeing it from consumer giants like Cadbury and Coca-Cola. Even Chipotle, the very place the wealthier customers are trading down from, is warning about a consumer pullback. This tells you the slowdown is broad, it's deep, and it's picking up speed.
The situation over at Wendy's is especially telling. They're not just seeing fewer customers. They're in a full-blown corporate crisis that's forcing a massive retreat. After already shutting down 250 locations earlier in the year, the company confirmed it's going to close hundreds more. This is a decline that's speeding up, with management saying straight up that their low-income customers are going to remain pressed.
But here's where the story takes a really ominous turn. Analysts have pointed out that Wendy's current stock chart is tracking with alarming similarity to its steep nosedive right before the 2008 financial crisis. This isn't just a bad quarter. This is a pattern of corporate behavior that we've only seen on the edge of a major economic meltdown, and it suggests things are way more fragile than the official story lets on.
And this financial pain isn't just about cutting back on treats, it's hitting basic needs. The consumer staples sector, companies that sell essential goods like toothpaste and toilet paper, is supposed to be a safe bet in tough times, but it's performing horribly. In a recent period, 32 of the 37 stocks in that index were in the red. That shows you that people are so squeezed, they're being forced to cut back even on the essentials.
All of this brings us to Section 4, this massive disconnect between the official story and real life. It's like we're living in a tale of two economies. There's the one you hear about in the headlines, strong growth, great job market, and then there's the one that average households are actually living in, a reality of crippling debt and constant financial anxiety.
The job market is a perfect example of this illusion. A recent report was celebrated for adding 42,000 private sector jobs. Sounds good, right? But if you dig into the report's own data, you find a very different story. Small and mid-sized businesses, the actual engine of the American economy, shed 40,000 jobs. The positive headline was just a statistical quirk that completely papered over the weakness in the economy's backbone.
And we see the exact same illusion in the services sector. Headlines were cheering about expansion, but there was a huge contradiction buried inside. The employment index was actually shrinking for the 5th month in a row. Why would that happen? Because business backlogs, basically the pile of future work they have lined up, have been collapsing for 8 straight months. Businesses are letting people go because they can see the future and it's looking pretty empty.
And this is the reality on the ground. Evictions and foreclosures are on the rise. Food banks are seeing demand they haven't seen since the Great Recession. Credit card balances are at all-time highs, not because people are buying yachts, but because families are putting groceries and gas on a Visa. This isn't aspirational debt, it is survival debt. And when people start missing payments on that debt, you know the tank is truly empty.
The auto loan market is a perfect little snapshot of this K-shaped disaster. At the top end, you've got wealthy buyers taking on $1,000 a month payments for new cars. At the bottom end, the subprime market is collapsing, with repossessions climbing back toward crisis levels. When a family defaults on their car loan, which is often their only way to get to work, it's a sign they're being forced to make absolutely impossible choices.
This quote from the source material just perfectly captures what it feels like for the bottom half of the economy. The system for so many isn't delivering wealth. It's delivering new and more creative ways to trap people in debt for life, swapping out savings for credit and stable jobs for gig work.
And this brings us to our final section, where we get to the real root of this whole mess. The sticker shock that's pricing people out of a hamburger isn't some new problem. It's a symptom of a much deeper, systemic disease. a crisis of debt and inflation that's been building for decades.
To borrow a famous political line, it's the debt. The core problem here isn't just that McDonald's got expensive all of a sudden. It's that the value of the actual dollar in your pocket has been deliberately and systematically destroyed over decades of policy decisions.
This timeline really tells the whole story. The gap between that 59-cent hamburger in our collective memory and the $15 meal of today, that represents the massive chasm between what a worker earns and what things actually cost. Over the last several decades, household income, when you adjust for real-world inflation, just hasn't kept up with the explosive price increases of everything essential, from housing to food to education. This debt-based system creates two completely different paths for survival. A corporation like Wendy's and strategically cut off its failing parts. It can close hundreds of stores that aren't making money to save the whole company. A household doesn't have that luxury. When a family's debts are bigger than their income, they can't just close a division. They are the failing part. Their only options are catastrophic, and that just reveals the system's fundamental inequality.
And this is exactly why the warnings coming from the drive-thru are maybe the most honest signals we have. The positive headline numbers are often backward-looking. They're statistical pictures of a reality that's already changed. The real leading indicators are the ones that look forward, the ones that measure pain, the collapse in fast food traffic, the emergency store closures, the rising defaults on survival debt.
You see, the K-shaped recession isn't some far-off theory. It's the reality for millions of people reported every single day from the front lines of the American economy. The consumer base is cracking under the immense weight of this long-term trend. And as it cracks, it threatens to bring the entire debt-heavy structure of the economy down with it. So the question we're all left with is this: what happens when it finally breaks apart?